looking at the payables turnover, we're looking at how long it takes us from the receipt of inventory until we pay the suppliers for that inventory. So this is cost of goods sold divided by accounts payable. Of course, this assumes that the only items in accounts payable are payments to suppliers for inventory. The payables turnover for this company is 3.91 times. That means that we pay off our entire inventory or turn over our payables 3.91 times per year. The day costs in payables is 365 divided by our payables turnover. This means on average, we are paying off our payables every 93.42 days. Now, this is not necessarily a bad number for us because this means that we're able to do other stuff with our cash for those 93 days instead of paying our suppliers. Our suppliers might not be very happy with this number, though, and suppliers might not be inclined to extend credit to a company that takes 93 days to pay them back for that credit sale. Next, we look at the asset turnover ratios. So the asset turnover ratios tells us how well we are using our assets to generate sales. We take sales divided by total assets. And what we see here is that for every dollar in assets, we are able to generate 66 cents in sales revenues. We then have our capital intensity ratio. The capital intensity ratio is 1 divided by our total asset turnover. What this is an indicator of, it could be an indicator of how much we are dependent on older assets, what future outlay we might have necessary of capital in order to continue make our payments. This is the amount of assets our business requires to generate $1 in sales. So this means that we need $1.54 currently in assets to generate a full dollar of sales. The smaller figure is better. The lower it is, that means the less capital we need available to run our business. Now we have the profitability measures. First one is our profit margin. Profit margin is net income divided by sales. So how much profit do we get to keep from our sales? So for every dollar in sales, we keep 20 cents of profit. Then our return on assets, which is net income divided by total assets. Return on assets is a measure of the profit per dollar of assets. So we get 13 cents per dollar in assets. And then the return on equity, which is net income divided by total equity. The return on equity shows us that we generate 18 cents in profit for every dollar that we have in equity. Now, remember, this is based on historical accounting information. So this is based on book assets and book equity. Then we have our market value ratios. The market value ratios look at information about our company's stock. So we need the market price per share, the number of shares outstanding. Our earnings per share is net income divided by the number of shares outstanding. So this tells us how much net income is generated per share. Next is the PE ratio, or the price earnings ratio. The price earnings ratio is market price divided by our earnings per share. This PE ratio looks at how expensive a stock is relative to the amount of income that a company generates. It's a good measure of market value. The next measure is price sales ratio. So this is the price per share divided by the sales per share, which is calculated by taking the total sales or revenues divided by the number of shares outstanding. This shows that the price of the stock is 1.61 times the sales dollar earned per share. And then we have market to book ratio. First, we need to determine what the book value per share is. Book value per share is total equity divided by the number of shares outstanding. So we have a book value per share of $79.55. Then we have our price per share currently at market value, which is $115. For the market to book ratio, we take the current purchase price per share divided by the book value per share. So currently our market price is 1.45 times higher than our current book value per share. When we're looking at market value ratios, instead of net income, we might want to look more at the cash value or the amount of cash that we have. So first we have the enterprise value, which is the total market value of the stock plus the book value of all liabilities minus cash. This gives us the enterprise value of the information. Then we would look at the EBITDA, it's called. And this is E earnings before interest and taxes, EBIT, plus depreciation and amortization. So this is a recognition that net income does not equal the cash flows within an organization. So we need to take our earnings before interest and taxes and add back depreciation and amortization to get our EBITDA, it's called EBITDA ratio, which is the enterprise value divided by EBITDA, or 4.62 times. When we look at Prufrock's ratios then as a whole, we can get a sense of how well this company is doing in general. And then if we had multiple years of information plus competitor information, we could really tell how well we were doing in our competitor analysis, and we could make financial predictions about their future based on their historical performance. Now, it's not always easy to do that because if we have years where our numbers fluctuate greatly, then it's harder for us to make financial analysis projections based on historical information. We also need to know that ratio analysis is based on imperfect information. If we had perfect information, we would just have market data about every company, but we don't have that available to us. What we generally have available to us is financial statements. And financial statements are based on historical accounting information. We also know that that accounting information can change from day to day, which will affect these ratios. So when we look at some of that information, for example, I can look at the current ratio. So the current ratio for this company is currently 1.29. Anything over 1 is good. That is what we're looking for. However, if the reason that they were over 1 is because they took out a loan and got a bunch of cash, That makes the current ratio, current assets are affected by an increase in cash, but it doesn't affect current liabilities because a loan is generally a long-term liability. That can make the current ratio look a lot better than it actually is in the long run when we consider the fact that they took on long-term debt in order to boost their current ratio. So the financial analysis is important and it gives us valuable information, but we really have to take it as a whole and look at these companies and what is happening in order to get a clear picture of how financially stable they are and ways that ratios have changed from one year to another. You can see here financial information for Lowe's and Home Depot. Now, we can see that Home Depot is much larger than Lowe's. However, when we start looking at the ratio analysis, we see that their current ratio is actually fairly similar. They both have a current ratio just slightly above 1. The debt to equity ratio, however, is much higher for Home Depot, which tells us that Home Depot is carrying a lot more debt than Lowe's. Their profit margin, return on equity, and return on assets. We can look at this information. We see the market to book ratio. We can see that Home Depot is selling much higher on the market than Lowe's is, 159 times the market value to their book ratio. We also have to remember, because of that accounting information, that if the Home Depot has a par value of $1 on their stock, their common stock in their books could be a lot lower than their market value just because of how the stock is carried on their balance sheet. Where Lowe's, if they have a $5 par value, would automatically have a different market to book ratio just because of that, not even just because of market price. So we have to take this information holistically to determine stuff. Their PE ratios are very close to each other. So they're both around 24, 25, 26. That's a very consistent PE ratio. But things that we would look at when we're comparing companies from one another, they might be in the same industry, but we can see that their information is very different.